Good afternoon, everybody. Today is Friday, the 10th of June, 2011, and we had further weakness here, obviously, today. Markets on average were down about 1.5% on the day, and obviously for the week, much worse than that. The NASDAQ started out the year, that is, the Qs started out the year at 54.46. So dipping down into negative territory next week seems likely. We're getting down now to this 200-day moving average. So again, moving averages are, like a magnetic force field. They often provide an area where we find a bounce, but the 150-day moving average obviously failed miserably in the NASDAQ, and of course the S&P 500, it failed as well. And a couple weeks ago, it would have really seemed wild to think that we would be talking about the markets coming down to their 200-day moving averages, but that's exactly what we have happening here. I think that what's really been leading this market, a lot of people have been focused on the financials. The financials have been a slow, steady bleed since mid-February, and that pace really picked up, obviously, the last 2 weeks. But to me, what really kind of, I think, led the market here the last couple of weeks to the downside was that failed breakout in the retailers. That from that failed move came this fast move, and when we look at the weekly chart again, we were talking a couple of weeks ago about this level possibly being an important level. That if it broke down through it, that it could be more trouble. I didn't expect, and I don't think most people expected it to be this much trouble. That it would have not only broken that 50-day moving average in this prior resistance, but also came down crashing through the 100, the 150, and now here it is actually below the 200-day moving average. The 200-day moving average on the retail stocks, the retail holders that is 104.21, and we're right now at 104.06. So again, you can look at these markets and you can tell yourself over and over again that they're down too much, that it has to bounce, or the things that you tell yourself. But until there's evidence of a bounce that's going to hold, you just can't trade it. And you look at these markets. And again, I talk a lot about, obviously, the 5-day moving average, where we are in relation to it, and being able to make a higher high and a higher low above a 5-day moving average that's begun to flatten out. These markets yesterday kind of looked encouraging to me, and truth is, I came in with some SPY calls. I bought them late in the day yesterday. I was looking at, in the chat room, what we were talking about was we'd seen this market come up to that 130 level, and it just seemed like there was too much bearishness. So we waited for this pullback and bought some of the 130s, the SPY 130s that expired today, and we bought those at 24 cents average, I think. And I was looking at it thinking, well, what would take the market by surprise? And I was telling subscribers that, listen, this is a complete gamble. If we're going to take some overnight exposure, let's do it with options. Let's not try to go in and load our accounts with the SPY or the SSO or the UPRO or BGU or any of those levered funds. Instead, we can know exactly what our risk is. And if this market had gone the other way, it could have gone maybe up towards 131 and a quarter is what I was thinking, and to pay 25 cents or whatever it was to potentially make that kind of upside, with knowing that here's exactly what my risk is. That's what made sense to me today. So obviously I came in this morning. It was down. They were down at 5 cents, 2 cents, something like that, and they expired worthless. But the point is, if you're going to try to pick a turning point, what you have to do always, our job as traders, and the only way you're gonna survive and stay in this business, is to manage risk. And there's gonna be times the market will reward you with a bet like that, and that's all it was. And that's what we spoke about was, listen, be prepared mentally to lose everything that you put into this. If you're buying these call options, be prepared to lose every single penny that you put into them. So with that in mind, treat it as a stop loss, that you're going to get your answer tomorrow, most likely on the open, whether this is a good bet or not. Obviously it wasn't a good bet. the options expired worthless, and the market continued to go down, but the losses didn't continue. Is the point there? Anyways, back to the SPY. We've got the 200-day moving average pretty much near the lows for the year. The S&P 500 is doing better on a year-to-date basis than obviously the Nasdaq and the Russell, which is down year-to-date actually, but still looks like there's room for some bleeding, maybe down towards that 200-day moving average. So we're not out of the woods yet. There might be a bounce in here, and if there is, the way we ought to be looking for it is in low risk ways, and looking again, when we have a declining 5-day moving average, odds generally do not favor a turnaround, but sometimes you take a shot at it, and as long as you can control risk, that's the key. Obviously, 130 is a big level for this market. We're 2.5 points away from there now, though. So we found some resistance today at the lows from midweek. That's not what you want to see, obviously, because it looked like maybe the market was going to try to, and that's actually interesting on the E-minis. The E-minis came right down perfectly to daily S2 and then bounced perfectly right up to the volume weighted average price. This is where it looked like maybe they were going to try to get this thing going again, but obviously that wasn't meant to happen. There's no turnaround in this market yet, and it seems as though that the date is with this 200-day moving average down near about 125.50. So it's down a lot. It looks ugly, and we're probably I've tried the bounce play a couple times in here this week. It didn't work. I found it to be a choppy week, but probably because I was fighting the trend really. And getting my opinion in the way of what was actually happening price wise, and you learn from those mistakes, and unfortunately, even if you've been trading for close to 2 decades, those are still little mistakes that you make and fall into those traps. So the bottom line is risk management. You dust off, you get back next week, and you start all over again. But anyways, I was going to say about my trading as well. I also overtraded this week, which I've been doing so good with keeping my personal trading low, and it's been really working well for me. But kind of picked up that crack pipe again this week, I guess. Anyways, for next week, maybe we get a gap lower on Monday and come down and touch or go through that 200-day moving average. I'm not here to talk about the economics, but obviously there was a lot of economic news, and particularly Bernanke's speech this, what was that, Wednesday afternoon? It was right here. So that was, I guess, Tuesday afternoon. But anyways, maybe we're going to get a flush out, but again, this market is a high risk environment. They seem like they're down too much to sell short, but true momentum is really showing that the sellers are still in control. So again, my biggest lesson I can say to you guys, and I even said it earlier in the week. I said it on Monday. I said it on Wednesday. Is to don't be this sucker basically who tries to pick the bottom, and I ended up being that guy. But again, not in a really harmful way. So hopefully it wasn't in a real harmful way for you guys as well. But anyways, we're still weak. We could turn and have one of these phenomenal bounces. At a minimum, what you want to see on any day is that we're above and can hold above the volume weighted average price, and that volume weighted average price begins to turn higher, and we make a series of higher highs and higher lows above it. That would be the best, the first clue that this market is beginning to turn. And it looked like this afternoon maybe we were going to get that, but all bets off. It broke back down. So that's if you're going to play that short-term game, you have to realize that you can't look at a 150-day moving average, a 200-day moving average, or any of these other oscillators or indicators or prior levels where the market touched and bounced. Those were prior important levels. There's nothing here to say that they're going to be again this time. Now this level down near 125 obviously does take on further significance because it's the prior support that we bounced from, prior intraday support, and it's that 200-day moving average. I bet if we back it up on a weekly chart, we might even find more significance in there at this what is this, the 125 level. And that we've got the trend line maybe down closer to about 123, but that's the way it's looking. It's still the seller's still in control here, and Nasdaq, we're just, what is this, about 30-40 cents away from going negative year to date. And then we've got the tsunami lows down here at 53.75-ish area, and I'm just eyeballing that level. So we're still bleeding. It's still ugly if you're trying to pick a low, but really, I mean, look at I look at this, and I look at, and I do what everyone else does after the fact, is say, what the hell was I thinking in there? Because the opportunity looks so obvious, but after 5 days down straight, it seems like it's going to bounce, but you wait for the evidence at least before you get aggressive. And in the Nasdaq next week, obviously, these 55 and a quarter-ish area is important. Then we're going to see 55.70-ish. Really for a bounce to sustain, and maybe we get a gap down, and then we rocket right back up towards that 5-day moving average. Those little bottoms occur as well, and again, the best way to find them is using a volume weighted average price type movement, that maybe we get some early selling and like this, and then we get that movement back up through the volume weighted average price. It kind of turns sideways, and then what we also need to see would be some volume. We need some volume in here on these little rally attempts, and then lighter then lighter volume on these little pullbacks towards VWAP and these higher lows. If that occurs, it's a big if. Nobody knows what's the market going to do next week, but we want to be prepared for all scenarios. We want to know what's the potential risk, where how much can I make. That's a little bit trickier, because you look at this and say, well, maybe a run up towards the 5-day moving average. That would be an initial target. Today, we had, you can look at these targets, and this afternoon I was looking at the SPY after it, it looked like it was consolidating, right in here above the volume weighted average price. I was a little bit long in here looking for a bounce up towards the 2-day volume weighted average price, which was up in this area. That was a potential level to look for. It didn't happen. I cut out of there, and I think that trade was actually, I think it was profitable, but not much. And again, I was looking for, hey, well, maybe shorts cover here at the late in the week. But anyways, back to the Nasdaq. We're down a lot real quick, and it seems like it should bounce. And coming in on Wednesday, I think it was, and I'd mentioned that, I think I mentioned this on the show. Someone had mentioned that 5 out of 5 times, or 11 out of 11 prior times, the market was down 5 days in a row. It bounced. Well, those numbers, those 11 out of 12 now. They're interesting facts, but not something to trade on. They're just about as interesting as where the 150-day moving average is, you could argue, or what the PE is. The fact is, PE ratios aren't a trading system, or they shouldn't be, in my opinion. Moving averages aren't a trading system, or shouldn't be, in my opinion. There are places to observe the action and say, are the buyers showing up? Do we see evidence that the buyers are taking control? Because they did it at the 50-day, they did it at the 100-day. Now it seems to make sense they would try at the 100-day. But wait a minute, we look intraday, and what do we see? We just see lower highs and lower lows. So maybe you take a shot, you get stopped out. That's trading, Anyways, you have to do what's right for you. And the people who are going to be scrambling on the short side to cover are the people who maybe overstay their welcome, just like the longs overstayed their welcome, and now we've got the Russell 2000 also within distance of easy distance of a very important, what's been an important level this year is basically about this 77 level where we've seen support a few times, and we've got that rising 200-day moving average just down below there as well. So next week is going to be, we're coming into these big important levels after what's been a pretty violent sell-off here in terms of the quickness or the intensity. So when you look at the possibility for next week, I think I came into this week saying, hey, it looks we should be looking for a bounce near that 150-day moving average. Looking for a bounce versus buying aggressively and holding on is a lot different. There's a big difference between the two, is what I meant to say there. Next week, I think that it does make sense that after the magnitude of this decline, I mean, we've seen the Russell go basically from 85 to 78, 7 points. So what is that, about 8% maybe or something like that? And over the course of this sell-off, that's a pretty big sell-off, and typically you're going to get some kind of a bounce. But not all big sell-offs get a big bounce either. So keep that in mind. There's no sure way to make money in the market ever. Risk management is the most important job, but it's going to make sense to look for the possibility of a turn in these markets, I think. The semiconductors really got obliterated here too recently. I mean, it was just 3 weeks ago that these things were threatening to break to new highs again, and instead we've seen that support became resistance. We lost this prior resistance as support. We lost the 50-day, the 100-day, the 150, and now we're within spitting distance of this 200-day moving average, down close to, so I guess it's 32.42 if I'm looking at that right, $32.42. And we've got this prior important level, and maybe we're going to take these things negative for the year as well. Where'd we start the year on this? 32.53. 32.53 was where we finished last year. So maybe these things all go negative slightly and really produce the fear from that fear-driven sell-off with maybe some increasing volume. And let's just take a look at these markets. We're seeing a little bit more volume in here today in the SPY and in the Qs, but really not that big volume that usually comes near a turning point. So the evidence just isn't there that we're ready to turn higher. That's really what we have to go with, is the evidence. And the evidence says it's just not in the cards, not yet. We've got a steady pattern of lower highs and lower lows in these semiconductors. And I mean, you think about where we were just 2-3 months ago. We were in the throes of this fantastic bull run, and now we're for the second time this year. And this is why I think these periods really emphasize why the correct way, or why I think the correct way to approach the market is trading and having some exposure, or at least being out during these periods of decline. Joe Fahmy does a great job of that. He always talks about it and manages his accounts well by doing that. Stepping aside in periods of decline. You don't have to make money all the time. Of course, we all want to be involved in these massive sell-offs and catch these big rallies, but no one does all that. If you can catch a piece of them, a piece of the sell-off, or just sidestep the sell-off, if you're a bear market specialist, if you can sidestep these rallies and know when to go sell short, then that's what you ought to be doing personally. So anyways, the semiconductors, maybe we're going to test that 200-day moving average and the 32 and a half-ish area. Financials just again decimated, starting to show. We had big volume without further downside. Now there's a phrase: big volume without further downside equals accumulation. Someone asked me in the chat room today, is this volume and buying that was happening in the financials here late in the day, and here's the 1 minute chart. Is this short covering volume, or is this people going long? And my answer was, well, one, you never know for certain, but generally the cycle feeds itself. That maybe you get some people, you get some news. I guess there was news on one of the financial hack channels that is jealous of StockTwits or something like that. But one of these channels was talking about some news for the banks. The banks really started lighting up, and the question was, is this real buying in here in these financials, or is this just short covering? Well, just short covering, buying is buying, and if you have less supply and you have more demand, price goes higher. Now, you've got your knee-jerk short squeeze rallies, which when you're in a downtrend like this, the shorts really have no reason to panic other than to think, well, hey, I'm going to be the first to lock in my gains. But you've got in the financials an interesting level for next week. That now this market's holding up better than which let us down. That in the retailers. Is starting to show signs that, hey, maybe if getting back above some of this resistance in 1505, that maybe the financials will be the catalyst for such a bounce. Who knows? I mean, we've got a lot to think about over the weekend. Obviously, the market felt like a longer week, and maybe that's because last week was a 4-day week and this was 5 days. But anyways, hope everyone avoided major carnage, and I will talk to you again next week. Thank you for tuning in.